Morning from our global headquarters in New York. I'm Menace Crenny. Welcome to Bloomberg Brief. Let's set that agenda. Market calm ahead of the last CPI before the Fed decision. Looking at a fourth month of firm gains in prices. FX volatility this morning on the rise. BOJ sees little cost to waiting for rate hikes. China is said to be mulling a yuan devaluation. And President-elect Trump picks Andrew Ferguson as the chair of the FTC to replace Lina Khan. Good morning. There's an uneasy calm, uneasy hesitancy, depends which word you want to choose, ahead of the CPI today. Julian Emanuel will be with us a little bit later on. Evercore say you've got exuberance rising, but there's a risk of exuberant corrections. Bank of America say we're underpricing the CPI reaction function today in markets. Roll it over, have a look at the bond markets, because we are looking for a plus 0.3% for a fourth consecutive month. Stubborn CPI, what does it mean for PCE? We will ask UBS. By the way, bond traders, JP Morgan have got their survey out. They're trimming their long bets. We're at neutral versus the strongest long bias of 2024. And we mentioned foreign exchange in the headlines. Let me just show you one day's volatility in dollar yen. I love it. The BOJ, it's a Bloomberg scoop. BOJ sees little cost in waiting for the next rate hike. We can wait to January or a little bit longer. There'll be no huge cost. Of course, we get the Tankan on Friday. We're also keeping an eye on these stocks. This is what's on our radar. US steel, it fell over 9% at the close. That's after the news that President Biden has plans to formally block its $14.1 billion deal with Nippon Steel. GM, Mary Barra, has a lot to contend with. She is she's made an announcement that they're shutting down the robo-taxi business, citing the high costs to develop the technology. And Macy's falling pre-market. We're preparing for the report. Those results will become before the bell. We'll give you a little bit of a preview. And in just a few moments, Abigail Watt of UBS will join me to discuss CPI. Later in the hour, as I say, Julian Emanuel. We'll talk markets with him from Evercore ISI. So we're counting down to this CPI data. It'll provide the latest hint on what the Federal Reserve may do at their next meeting. Here's what Governor Chris Waller had to say a little bit earlier this month.
At present, I lean towards supporting a cut to the policy rate at our December meeting. But that decision will depend on whether data that we receive before then surprises to the upside and alters my forecast for the path of inflation.
Joining me now is Abigail Watt, UBS Economist. Abigail, good to have you with me this morning. We have an issue around the pace of disinflation. How stubborn is it, and has disinflation stalled? If we look at this CPI number, we're expecting plus 0.3% for the fourth month in a row.
Yeah, so I think, we had expected to see some stickiness into the end of the year in the inflation data. This is something that we'd been anticipating, and we actually have an above consensus expectation for the CPI print this week. So our expectation is that we see core and headline both coming in at around 31 basis points today. I think the key thing to note, though, is for the FOMC, it's not just the kind of level that we see, but also the kind of composition of what's driving that inflation. And as well as that, I think the other thing to note is the importance of kind of the other inflation data that we'll get throughout this week, both the PPI and the import prices, because those will also inform our expectations for PCE prices. Now, obviously, the FOMC is targeting PCE. Now, our expectation is that we actually see the wedge between CPI and PCE kind of widening a little bit this month, despite our expectations for kind of core CPI to come in a little bit stronger. We still see core PCE prices kind of stepping down in November. So we're currently tracking a 19 basis point increase in core PCE prices, which would be a step down from the 27 basis points that we saw in October. And I think it's important to kind of make that distinction that we need to kind of look at the kind of both the composition of the CPI data today, but also kind of what the translation to kind of PCE prices will be off the back of the data.
So that PCE, obviously leaning into the PCE post the CPI, is where Chris Waller potentially will be a little bit more focused. He said he's still leaning towards a cut. That PCE data, that makes it justifiable to cut in December in your view and then pause?
Yeah, so our expectations are that we do see them deliver a 25 basis point cut at the meeting next week. Obviously, I think it depends kind of, again, where we see the surprises in the potential for the kind of CPI print today. We're expecting to see actually, and I think this is an interesting element of our forecast, we are still expecting to see kind of a step down in owner equivalent rents. And I think that is one of the components, obviously, that we've kind of heard the FOMC have been looking at in terms of that kind of inflation stickiness and the path ahead for inflation. Now, our expectation is, as you said, we think that they'll cut next week and they'll potentially kind of pause at their January meeting. And that's because we see kind of them looking at a kind of core PCE annual number of around 2.9% as they go into that January meeting. And that's where we think they'll potentially kind of deliver that kind of pause. And I think that the key thing to note, though, is that even with this stickiness and inflation kind of into the end of the year, our expectation is that we do begin to see kind of further progress as we move into kind of Q1 next year. And that's because the monthly prints, we think, will kind of lap lower relative to the monthly prints that we had at the beginning of this year. We still think you'll see the kind of usual seasonal pickup in kind of January and February with kind of annual price resetting taking place at the beginning of the year. But we do think that the kind of year over year rates will begin to kind of move lower. And with that, we think that they'd be back on track to kind of deliver another 25 basis point cut by the March meeting.
Okay, and part of this narrative is about whether we see a shift in productivity. Let's just listen to my guest from yesterday from Peel Hunt, Callum Pickering, on reflecting on the 1990s and maybe what we get for productivity right now. Let's take a listen.
What I think we've got here in the US is a strong productivity upswing, which is helping to bring price disinflation down and keep it under control. We had something very similar in the 1990s. Greenspan didn't raise interest rates into an upswing. Why? Because he saw that productivity was strong on the underside. So I think that's the story with productivity. What makes me much more nervous is US 7% deficit. That's a problem. What happens if, for whatever reason, you get a business cycle downturn and you get some unemployment? And what happens if the good news priced into markets just doesn't play out?
Now, you could argue we've got a lot of good news priced into these markets and everybody's worried about the deficit. But let's just reflect on that. How much of a believer are you and the team at UBS in this paradigm shift in productivity? Because it's integral to the inflation and the disinflation narrative, isn't it?
Yeah, so I mean, I think it's a very challenging thing in real time to see in the data. I think being able to see kind of the potential impact from kind of AI, for example, some of these kind of big technological changes in real time is a very challenging thing to see. And actually capturing productivity itself is quite a challenging thing to measure. But I think as well as kind of productivity, the other thing that's important is the kind of change in population growth. And that has been, I think, one of the kind of key drivers in terms of the ability for us to continue to see the disinflation progress that we have seen in the US, despite the fact that we've seen the economy kind of running above trend. I do think that's one of the kind of key elements here is kind of what we see happening in terms of population growth. And obviously that feeds into people's estimates of kind of where potential is too. We actually kind of marked down our expectations for population growth in our latest outlook. And that's largely because of kind of some of the kind of potential changes with the kind of new administration around immigration. I do think that's kind of going to be an important factor kind of as we go into the kind of next year and the coming years in terms of kind of potential growth is kind of what we see happening in terms of the kind of population growth side of the economy.
Abby, thank you very much. Abigail Watt there of UBS, setting the agenda for CPI a little bit later on today. Good to see you today, Abby. Other stories trending on your Bloomberg terminal this morning. HSBC plans to cut costs by at least $3 billion. It's all part of the restructuring under the new CEO. Reductions to senior staffers are expected to axe a little over 40% of the company's top 175 managers. A spokesperson for HSBC declined to comment. SpaceX and its investors have agreed to purchase as much as $1.25 billion of insider shares in a transaction valuing Elon Musk's rocket and satellite maker at about $350 billion. The per share price, $185, is up substantially from the $112 set in a prior valuation less than 3 months ago, and cements the status as the most valuable private startup in the world. President Macron is seeking to name a new premier within 48 hours and is meeting with the major parties to form a cabinet. he's looking to form a coalition of moderates to avoid new legislative election and free his government from the influence of National Rally leader Marine Le Pen. Coming up, Lina Khan's days at the FTC, they're ticking down. President-elect Donald Trump picks her replacement. More on who that is on Bloomberg Brief.
Lina Khan seems to have missed the entire economic section in her college experience, because the role that she played in really reducing and eroding American productivity was profound. So I think that for the United States, all these issues around tariffs and this and that, how much are we going to drill? It's all second order. First order, we're back to business.
That was the Citadel founder, Ken Griffin, speaking at the New York Times Deal Book Summit a little bit earlier this month on Lina Khan, who, of course, heads the FTC. We're less than 6 weeks before President-elect Donald Trump, I should say, re-enters the White House. And he's tapped Andrew Ferguson to chair the FTC. Trump wrote on Truth Social this: Andrew has a proven record standing up to big tech censorship, protecting the freedom of speech in our great country. Andrew will be the most America First, most and pro-innovation FTC chair in our country's history. For more, let's get to Kate Ferguson. She joins us now to bring us up to speed. So, Kate Ackley, look, Andrew Ferguson, what are we going to get that's going to be so different to Lina Khan in terms of the approach? You heard Ken Griffin, a pretty damning assessment of Lina Khan and what she did to American business during her tenure.
Well, thanks for having me. Good morning. Yes, Lina Khan has been a real sort of thorn in the side of the business world, even as she's had some, words of support from some Republicans on Capitol Hill, including Vice President-elect J.D. Vance has said sort of flattering things about her. But it does look like this signals a shift in the agency's direction toward business, which is not a surprise. I mean, we've seen a lot of these picks have business and industry backgrounds. Ferguson has talked tough on big tech. In that way is like Lina Khan a bit. He sounds a lot like Elon Musk, taking the free speech aspect of big tech and like you said about the censorship. But I think overall, we would expect to see, and the business world is expecting to see, a lighter touch from him as chair.
Yeah, well, I think on Twitter he said, at the FTC, we will end big tech's vendetta against competition and free speech. And everybody's so bulled up that there's going to be more tech deals and exits next year. Let's talk about the Biden administration. We're counting down. There's 40 days left of this administration. And they're weighing new sanctions against Russian oil. I mean, a great deal was made, Kate, wasn't it, of this price cap. There was a lot of prevarication the first time around. But oil and gas prices were much higher. Why does Biden feel the need to move more harshly and more aggressively now? It's almost as if he's emboldened in these last dying days of his administration.
Right. He doesn't have a lot to lose. I mean, he's not setting the stage for his picked successor. He's not, returning to the White House. He'll be gone in about 40 days, as you said. So there's not a lot to lose, and it's seen as this could be the opportunity, these final days of the Biden administration, to really put the squeeze on Putin. And you mentioned gas prices are pretty low right now, relatively, and it isn't like it was in the run-up to the election, where there was a concern about gas prices and the sense that goods were very expensive, inflation was high. So you don't have those considerations right now for the Biden team.
No, and certainly the proposition will be is whether it's as harsh on Russia as it was on Iran, and that will have flow consequences for the oil market. Talk to me about Nippon Steel. It looks as if the president is about to block this deal. There have been ongoing discussions between Nippon Steel and the unions. The unions, they just won't budge. They just don't believe that this deal is good for their workers, do they?
No, and it's been a huge lobbying fight. Both of these companies have hired up some of the top lobbying firms in Washington to push their case to try to ease this deal. It hasn't seemed to work. And if you look ahead to the next administration, President-elect Donald Trump has said that he also opposes the deal. Now, people can change their minds, who knows, but it doesn't seem like the change of administration would lead to a different outcome either.
No. Kate, thank you so much. Kate Ackley there on the very latest political stories making news headlines on Bloomberg Brief. Coming up in the show, the yuan is sliding after a report that China may allow the currency to weaken next year, but just how much will they allow the currency off the leash? Context matters on Bloomberg. Here's Bloomberg Brief. I'm Menace Cranny in New York. The front pages from around the world. These are the main headlines. First up, the New York Times leads with Syria's new leaders vowing to punish officials from the previous regime. The Rebel Alliance are looking to hunt down and discipline those who are implicated in the torture and other abuses. The announcement comes at a time when foreign powers are fighting for advantage in the country. Next up, Washington Post. A judge has rejected the sale of InfoWars, the satirical news site The Onion. The decision means conspiracy theorist Alex Jones could maintain control over the website, and another bidder could acquire the assets. Jones was forced to sell the platform to help pay roughly $1.5 billion in damages that he owes to the families of the victims of Sandy Hook Elementary School shooting, which he called a hoax. And Bloomberg leads with a foreign exchange story, the yuan. It falls after the report that China is weighing a weakening of the currency in 2025. Now, this would be a response to any potential trade war the United States may well launch. For more on the story, we're joined by Van Ram. The question goes through my mind, Van, is to what extent would they allow the currency to depreciate with the same velocity as they did in 2018, 620 to 720? Is that on the books?
Well, I think that is on the books, though on a milder scale, I would think, and a more gradual scale. I think that's the more important thing, because, what China doesn't want is a flight of capital from the country, which they are already preoccupied with. So they want a weakening of the currency because, of the three pillars of the economy, the property market, the consumption, and exports, it's exports that they need to fall back on the most, and for that they need a weaker yuan. So there is no question that they need a weaker yuan, but how they get to that lower target is the question, and they will do it gradually. It's going to be a drip feed. It's going to be watching the paint dry, because you're looking for excitement. It's not going to come from China's policymakers. If you look at the reference rate, Manus, this year, they've lowered it by just 1.5%. That's like almost baby steps. So they're probably saying we could go slightly faster from that. That's the message that I'm getting today. And let's see how it goes from here.
Brilliant. It's going to be like watching paint dry. So I'm not in for the rough and tumble in the yuan that I maybe had before. But here's the point. It's about the calibration of response. And the relationship, the import relationship with the United States is fundamentally different to it was during Trump 1.
Yeah, absolutely. I mean, they are now more reliant on, because of friendshoring and all those things that have taken place since the 2020 COVID situation. The situation on the reality on the ground is vastly different. Here is an economy that is now in deflation, which wasn't the case back then. So the economy is sputtering as it is. And if the Trump tariffs come on top of that, it will obviously have a huge effect on China's economy that is already grappling with deflation. So they need a weaker currency to a much more material extent than they did in 2018, Manus.
It's interesting because it depends which notes you read. JP Morgan say get ready for, they're calling it drop. They're called bracing for a storm. They're calling for a 10 to 15% drop, not like the paint drying that you're saying we're going to get, Ven. From the policy rhetoric that you've seen this week, the Politburo, one of the biggest policy pivots since 2011, moderately loose and proactive fiscal response. But is that enough to undershore or shore up domestic demand? Because that's the key.
Domestic demand is the key, but Chinese consumers are not traditionally spenders. They are savers. So the first step of the recovery, Manus, has to come from the export side. And when I talk about currency gradual moves, I don't think that we are looking at a 15% depreciation. I think China would shudder to think of depreciation on that scale. But we are talking about 3 to 5% from here, albeit in gradual measured steps. And I think 5% depreciation from here is definitely what they need to get the economy to out of deflation and into the good export growth. I mean, back 10 years ago, we used to get double-digit export growth every month, pretty much every month. Now, gone are those days completely. Even if they can't revive that old magic, they need to restore some of it. And they need a weaker yuan for that, and a materially weaker yuan, although it will be in gradual measured steps.
Okay, well, they want to do it without spooking the financial horses and that capital flight. Ben, thank you so much. Ben Ram there of Bloomberg on the potential policy reaction from the Chinese. I'll leave you with a snapshot of the foreign exchange boards this morning. This is what we've got for you. The sort of bigger move is on dollar-yen, as the narrative there is that, well, you know what, we can afford to wait. There's no great haste. They see little cost in waiting to hike rates. We're going to catch up with Julian Emanuel from Evercore on equity markets. This is Bloomberg. From our global headquarters in New York, I'm Menace Cranny. Welcome to Bloomberg Brief. Let's set your agenda. Market calm ahead of the last CPI before the Fed decision, looking at a fourth month of firm gains in prices. FX volatility on the rise. BOJ sees little cost to waiting for rate hikes. China is mulling a yuan devaluation. And President-elect Trump picks Andrew Ferguson as the chair of the FTC to replace Lina Khan. Good morning. There is an uneasy calm in these equity markets. What is your risk going into today? You're seriously underpriced in the reaction function, according to the Bank of America, in regards to this CPI. We're flat on equity. 6,050 is where we stand at the moment. We'll talk to Julian Emanuel in just a moment from Evercore. Exuberance is rising. Your risk is an exuberant correction. What could provoke that? Maybe the bond market. Have a look at the bonds. Core CPI, we're looking for plus 0.3% for a fourth month in a row. Flat, 423 is where we are. By the way, would you buy 10-year bonds in an auction today ahead of CPI, PCE, and a Fed decision? They rolled up for the other auctions earlier in the week. The bond survey is out from JP Morgan. They're neutral. The long bias has dissipated. Snapshot of the FX markets. This is what's going on in dollar-yen. We have a nuance from the Japanese. They see little cost in waiting. It's a Bloomberg scoop on the Bank of Japan. Sees little cost in waiting for the next rate hike. Could be January, could be a little bit later. Anyway, either way, it's strengthened the dollar and weakened the yen. We're 3 hours away from the November CPI data hitting the tape. Let's get into the details. Mike McKee is with us. Mike, the headline is plus 0.3% on the core, fourth month in a row. It's sticky, it's intransigent, but is that the most important part of this conversation?
Well, that's the most important part of the conversation is what is the conversation at this point for the Fed? You're right, it's been sticky, and we've seen a lot of acknowledgement of that from Fed officials. We're well above the 2% target still, and they have pledged to push that down, but do they continue making progress, or do they need to keep their foot on the brake a little bit longer and maybe pause in December? You can see we're quite a ways still from that target, and the issue now today is going to be out to 3 digits. Is it getting worse, or is it getting better? 0.3 on an unrounded basis would be the highest in 7 months. So Fed is going to be watching this closely. Do
you think that trumps the unemployment data? I mean, Friday week ago we were doing the unemployment data, and it was an unemployment rate ticking up to 4.2%. And Mohamed El-Erian said, look, that is what will drive the calibration of a rate cut in December.
It's both. It was a high 4.2. You almost rounded to 4.3. So we'll look at the core today and see if that rounds to 4.3 as well. The headline forecast is for 0.3 and the core for 0.3, but neither has breached that number yet. They've been 2.8 for core last month. We'll see if we get above that today. And if that gives any signals to people about where the Fed might be, they're kind of divided over what they should do next.
The translation will be, of course, to PCE, but just a conversation with the economist from UBS saying that the wedge between the two, they still see a dissipation in the PCE, and that will allow the Fed to continue their cutting cycle.
Well, we'll find out over the next 2 days, particularly tomorrow when we get
Yeah.
PPI numbers, because more of those, especially for healthcare, go into the overall PCE numbers. Plus, the CPI is distorted by the way housing is measured. It's a much bigger weight in the CPI than the PCE. And if you look at, and I'll just do this advertisement here, the ECAN function on Bloomberg, and you take apart where the inflation is in CPI, it's basically been in housing. That's the part that doesn't come down that the Fed's waiting for. So I'm not sure we're going to get any progress on that today, but until we do, you're still going to have problems getting closer to 2.
Okay, I'm going to start working analysis now on your ECAN function. Mike, thank you very much. Setting this up for the CPI. Mike and the surveillance team will bring you through that data a little bit later on this morning. My guest is Julian Emanuel, Senior Managing Director of Equity Derivatives and Quantitative Strategy over at Evercore ISI. Good morning to you. How are you?
Good morning.
So, spoiler alert. Mike just talked about owner equivalent rent. I've got UBS saying to me, nobody pays owner's equivalent rent, but we've got sticky inflation.
We do. And I have 2 sons that rent apartments in New York City, and I can tell you, it's sticky. And if you think about it, right, there have been 2 sort of material setbacks during 2024. The one was July and August, when the Bank of Japan ill-timed its last rate hike. Yep. Clearly, that's not going to be a problem this time around into a weak employment report. But the other one was back in April, when the perception was that inflation was sticky for several months in a row. Back then, clearly the downward path of inflation began anew as you got further on into the year. But we're again at this point where the perception is there's stickiness. And do you end up getting, in fact, a hawkish cut at the December 18th meeting? And all of those, in our mind, are near-term risks to a market that's run a very long way.
We are building a consensus towards a hawkish cut, though, in December. I mean, the word pause, I have to do a word search, but the word pause is now very much there. And even the Fed speakers are talking about a level of caution. So I think a hawkish cut is already in this market. Yeah,
no question about it. And the good news is the expectation of the 0.3.
Yes.
Okay. And again, when we look at the story of 2024, it's also been the market's ability to digest a decreasing amount of ease. Remember, at the beginning of the year, we were pricing in 7 cuts, I believe it was, for 2024. But again, at nearly 25 times earnings, the market's a little bit more sensitive to anything less than perfect news than it might have been otherwise.
Well, I like how you've topped your note, which is exuberance rising. And in that, you basically say exuberance is rising at valuations of 25.4 times. That's among the highest in the last 60 years. Stocks are vulnerable to less than perfect news. And that vulnerability, I want some context around you. Exuberance rising, we know that you've got a pretty solid call up there at 6,600. Other people are up in the 7,000s. But you do warn there's going to be the risk of exuberant corrections. Quantify an exuberant correction for me.
If you look back, we think 2025, again, as you say, is a higher continuation of the bull market. But again, going this deep into the 3rd year at these valuations, emotionalism, which is something we frequently see, and we think within the context of a year that's likely to look like President Trump's 2nd year of the first term, 2018, you had events like Volmageddon, you had, which was a 9% correction in a matter of a couple of weeks. That's what these things are likely to look like. Is it going to be that deep at this point? This is more like a pause. And again, in December, you tend not to have those type of corrections. But as we get towards the end of the year, and certainly as we get towards Inauguration Day, where we are likely to see a flurry of activity, the market will be reassessing its view.
Yeah, and as we get those headlines, I think I did a little bit of research. As we got the trade headlines in the first administration, it was about a 1% correction on the day. If we look backwards, we had a near bear market at the end of 2018. So we dropped by 12%. The cumulative loss over 2018-19 was 12%. But we almost made a bear market at the end of 2018. We don't have the same relationship with China that we did then.
No, we don't. But when you think about 2018, and we think this is why investors took such heart in the appointment of Scott Bessent for the Treasury Secretary, is that 2018, you had two things. Number one, the Fed was hiking. That's not going to be an issue this time. Yes, they may cut fewer times than the market expects now, but they won't be hiking, in our view, under really any circumstance. That Powell will leave to the next Fed chair, I suspect. But also, the other aspect of that was because inflation was sticky in 2018, long bond yields rose. And the feedback loop in 2025 about what kind of policy can be implemented, how it's going to unfold, is going to be very much a function of how the long bond reacts. And the Trump government understands this much more in detail than they did in 2018.
Well, that's the Bessent bounce. I mean, when we saw that announcement, you had that Bessent bounce on the money on the Monday. The question is, has he really got the capacity to get a fiscal deficit down to 3%?
These things do not happen overnight.
No.
And the Department of Government Efficiency is certainly one of those things where it's going to be a work in progress. But the key here again is if you look at the last few weeks, the 10-year yield has settled into that range between 4 and 4.5. And our view is when you look at 2025, a lot of the time will be spent between 4 and 4.5. And that's a tailwind for equities.
So that's a comfort zone for you. I was just looking at some of the momentum data the other day. We had one of the worst days for momentum on Monday this week. Momentum has been a huge driver to these markets. How important is that going to be going into 2025?
Well, the stocks that have led the bull market, you don't really want to see them falter. And frankly, when you think about how bull markets end, they tend to end in one of two ways. Either a recession is oncoming, which we don't see, or you get that irrational exuberance. And as we said, there is rational exuberance now, enough sufficient to cause a pause in the rally. But the irrational exuberance tends to be led by the stocks that got you here in the first place. So we would expect at some point momentum to resume its dominance. However, when you think about the seasonality, December and January, the losers tend to do better in the beginning of the following year. So we wouldn't expect momentum to reassert itself straight away.
Okay, well, let's hope we don't get another Volmageddon moment next year. But you know what? I would imagine we will get a few hairy days and a little bit of volatility. Julian, always great to get your opinion. That is Julian Emanuel of Evercore ISI. Coming up on the show, FTC, new chair. More on President-elect's pick for the seat on Bloomberg.
Lina Khan seems to have missed the entire economic section in her college experience because the role that she played in really reducing and eroding American productivity was profound. So I think that for the United States, all these issues around tariffs and this and that, how much are we going to drill? It's all second order. First order, we're back to business.
That was the Citadel founder, Ken Griffin, speaking at the New York Times Dealbook Summit earlier this month. And President-elect Donald Trump taps FTC Commissioner Andrew Ferguson to be the next chair. Trump wrote on Truth Social, Andrew has a proven record of standing up to big tech censorship, protecting freedom of speech in our great country. Andrew will be the most America First and pro-innovation FTC chair in our country's history. Joining me now, it is our government reporter, Kate Ackley. Kate, we know that Andrew Ferguson, I mean, he's an FTC commissioner. He's voted against, he's dissented against Lina Khan. You just heard Ken Griffin there, really quite visceral in regards to Lina Khan's tenure at the FTC. How different will Ferguson be?
Well, we're expecting that he will take a lighter touch than his current, who will be his predecessor, Lina Khan. He's been a critic of big tech and its censorship, what he calls censorship, particularly of conservative viewpoints. So he's not necessarily going to be a complete shift when it comes to big tech regulation or big tech, keeping an eye on big tech. But overall, seems to signal a more sort of pro-business shift at the agency.
Yeah, well, but he's already on Twitter saying the FTC will end big tech's vendetta against competition and free speech. And I think, as you said, it may be a little bit more towards the side of Musk when we caught up earlier. Talk to me about the Biden administration. They are thinking about harsher sanctions against Russian oil. I mean, there was a great deal of prevarication over the price cap the first time around. Why, with just 40 days to go, is Biden prepared to roll the energy political dice that he was so loathed to do in the past 3 years?
Well, he doesn't have that much to lose right now. You're not in the run-up to an election where, you're concerned about the price of gas and inflation on voters as they, would weigh that as they go into the voting booths. You don't have that. He's not setting the stage for his own picked successor. It's, President-elect Donald Trump is coming in. And so I think that, the reason that the Biden team is considering this is that they have, as you said, these waning days, 40-some days left to implement changes, to make policies. And so that's why they're taking a hard look at this without a lot to lose in terms of, and gas prices, if you've noticed, are pretty low right now.
They are. They're a heck of a lot lower than they were the first time around when we were looking at sanctions and the flow of oil onto the market. The president's also, we understand, ready to formally block Nippon Steel's proposed takeover of U.S. Steel. Now, we know Trump is also opposed to this deal in kind of principle. Why the final nail in the coffin now by Biden? What is the objective? Is it a political decision? Is it something that it's about his epitaph?
Well, this is something that's been a huge lobbying fight here in Washington over the past year plus. We've seen these companies both, hire up some of the top lobbying firms, try to sell their, case to the Biden administration, to people on Capitol Hill. It doesn't seem to be working. And in these, final days, it sounds like they're not going to get approval for this merger. The unions are opposed. So that gives you some insight. As you noted, there isn't going to be a big change from, the new administration coming in, with President-elect Trump saying he also opposes it. So, they're working through, the final details, but it doesn't look good for this potential merger.
OK, Kate, thank you very much. Kate Ackley there of Bloomberg Government. Now, one stock that we're going to be tracking through the morning, it is Macy's, set to report their third quarter earnings just before the bell. Let's get to Dasha Afanasieva for the latest. Dasha, look, we had the top level results a couple of weeks ago. That was with a special accounting announcement, $154 million in expenses that they were trying to get to the bottom of. So what do we get today? Do we get more clarity around revenue and this number?
That's right. They're going to drill down into the full results, and they're also going to have the conference call, which has been delayed 2 weeks, to give the company time to conduct an independent investigation into what happened. The reminder is that an individual apparently deliberately misreported delivery expenses amounting to as much as $154 million since 2021, and they're trying to get to the bottom of what's happened. And there's actually calls for a lawsuit. Law firms are sort of gathering people up to sue Macy's over this. So it's an extra problem for the retailer.
Well, they've got more than just that. They've got a new activist investor on the roster, Barrington. What are they calling for? I mean, it's not just, give us back a little bit more money, but it's a more sort of root and branch reconsideration of the shape of Macy's, isn't it?
Yes, well, together with Thor Equities, a real estate investor, they want a lot more money. They want an aggressive share buyback program because they reckon that that's the best use of Macy's money. On top of that, they want a separate subsidiary for the real estate arm. They want it to consider spinning off its higher-end chains like Bloomingdale's and Bluemercury. They also want seats on the board. They want them to close down their underperforming stores. And as I said, the share repurchases, of course, Macy's says it's going to work with investors, but it all, of course, speaks to this fundamental problem, which is that the real estate portfolio that Macy's has, which Thor estimates to be worth as much as $9 billion, isn't fully reflected in the market cap. The reminder is that Macy's, of course, fended off a takeover attempt, which was sort of based on these ideas earlier on from Brigade and Ark House. And in February, it brought in a turnaround plan, which actually included selling off some of the real estate, which it's been trying to do. But shares are down nearly 15% since then, suggesting that the new CEO, Tony Spring, hasn't fully won over the market yet.
I mean, where is Macy's positioned itself? We've come to the end of this reporting season by retail. Some have had sort of landmines of inventory. Others really haven't had to discount inventory that much. So what's the state for Macy's?
Macy's slightly beat the sales numbers. The sales didn't decline as much as the market expected. And I think its inventories rose about 3.9%, which is also, which it sort of framed as an improvement. So it's not doing too badly, but with activists breathing down its neck, I suspect the performance has to be a lot better. And I think one of the things that these new activists want is lower capital expenditure, which means less spending on things like overhauling, merchandising, and appealing to shoppers, and investment into Macy's as a retailer rather than a real estate company, which appears to be what these activists are more interested in, really.
Yeah, but they want that capex to come down to what, to 1.5% to 2% of total sales from 4%. So that is a significant drop in the capex, is what the demand is. Dasha, thank you very much. Dasha Fanasieva, counting us down to Macy's. Coming up, I'll set you up. It is CPI day. That's pretty much the only thing we need to focus on right here on Bloomberg Brief. Context matters. Bloomberg Brief, I'm Menace Cranny in New York. A look ahead to today, the main event. It is US CPI at 8:30 a.m. Then we have an exclusive interview with the Treasury Secretary, Janet Yellen. That is with Bloomberg's David Gura at 10:40 a.m. You have an auction, $39 billion worth of 10-year notes coming through. Some micro movers for you. This is what we've got. GM, they announced on Tuesday they're going to shut down the funding for robotaxi development of its cruise unit due to the high costs and the competitive market. Dave & Buster's earnings missed estimates, announced the resignation of the CEO, Chris Morris, and downgrades from Truist and William Blair. And you have GE Vernova extending its post-earnings decline. Revenue forecast for 2025 missed pretty much all the analysts' estimates. I'll leave you a snapshot of the bond market. I can tell you this. Bank of America say you really are underpricing the potential reaction on the CPI. We're looking for a core CPI of plus 0.3% for the fourth month in a row. Inflation or disinflation is stalling.